I want to talk to you today about IRS Schedule C rules for a qualified joint venture, married couple, unincorporated business. Do not go anywhere. Welcome back, folks, to another edition of the Awesome Sweetie Kiwi Show. How are you today? I hope you are doing fantastic. I'm doing marvelous if you were to ask me. If you are doing as terrific as I am, go grab a cup of coffee or tea or vodka and let's roll. In today's conversation, I want to talk to you about the QJV rules, especially when it comes to Schedule C. And first of all, how do you complete a Schedule C for a husband-wife partnership? That's a big question here, because when we talk about a qualified joint venture, we are actually talking about a husband-wife partnership. So this kind of partnership is a special type of business, and as such, it can file business taxes a little differently than other types of partnerships. So partnerships, as you probably know, must file income taxes on Form 1065, right? But a husband-wife partnership may be eligible to be considered as qualified joint venture and to file using Schedule C under certain circumstances, of course. Now, note that in this case, each owner must file a separate Schedule C, dividing up all of the income and expenses. So one thing I also want to clarify here is that when we talk about husband-wife partnership, this is valid also for same-sex partners, because as of June 2015, same-sex marriage is now legal in all 50 states. So it's still not clear how the new law will affect spouses as business owners, both for federal and state income taxes and for self-employment taxes. So I just want to clarify also that the information we're sharing with you today stems from our own research, as well as data gathered from the IRS official instructions. So if you need more information, you want to head to the IRS web link indicated on the screen right now, or you can contact your tax advisor. So what is, let's just get a little deeper here into the whole QJV thing. So a qualified joint venture is a tax filing option designed for spouses. I'm giving you now the official IRS definition. This is a tax filing option designed for spouses who go into business together as partnerships. The individuals in a QJV can separate or split the profit or losses of a partnership business when they each file a separate Schedule C for their portion of the business's income and expenses. Spouses who want to elect the QJV option must file joint married tax returns to take advantage of this option. A partnership is the only kind of business that can be treated as a QJV as of the day of this show. Sole proprietorships can't do so because, by definition, right, only one individual owns and runs this type of business. So one thing I want to say is that the IRS kind of recognizes that a business owned by two spouses is unique. So it made an exception for this type of entity beginning in the tax year 2007. And the Small Business Tax and Work Opportunity Tax Act of 2007 makes it easier for two spouses to file tax returns without having to file a complicated partnership returns. All right. Now, before I close on this section, a QJV is not a legal business type. No, it doesn't require any kind of formation at the state level. It is a concept developed by the IRS only to allow spouse owners of a partnership to file their business taxes as sole proprietors when they meet certain requirements. Now, how does a QJV work? This kind of tax entity requires that you must complete two Schedule Cs, one for each spouse. So each Schedule C would show that individual's share of income and expenses. Each Schedule C would show $50,000 in income if your spousal business had a net income of $100,000, for example. And if the partnership agreement designates that all income is split 50-50 between spouses, and you want to complete one Schedule C for the business to get the net income total, then use that Schedule C to divide all of the line items between spouses according to their percentage shares of the business. Very important. Do not file the combined Schedule C with the IRS. Please don't do that. because this will just confuse things and will delay processing of your return. And nobody wants that, right? So the husband and wife in a qualified joint venture must both pay self-employment taxes, which are Social Security and Medicare for self-employed business owners. Now, one thing I want to say here is that the self-employment tax for each spouse would actually be based on that person's share of the net income from the business. And each spouse should also file their own Schedule SE to calculate their self-employment tax liability. What are the pros and cons? Let's kind of talk a little bit about the pros of a QJV here. So electing to be taxed as a QJV offers a few advantages if you meet eligibility requirements. So you got to meet those requirements. It is less expensive and easier to file two Schedule C business tax forms than to file a complicated partnership income tax return for your business, right? Form 1065. And a partnership must file its own business tax return, which is an information return, then divide the income between the partners for tax purposes. We actually covered this in another show for how to file a Form 1065 or how to file Form 1120 for S corporation. And the process of filing a partnership tax return can mean hiring a tax professional, even for a simple two-person partnership, and it will make tax preparation more expensive. So both spouses receive Social Security, Medicare credits for business profits. And although spouses must pay self-employment taxes on their share of the profits, these taxes add to each spouse's Social Security, Medicare eligibility, and benefits. Let me talk to you quickly now about the requirements for a QJV. So your business is eligible to file business taxes as a qualified joint venture if you meet certain criteria. And the IRS is very adamant about those criteria. First, your business cannot be a corporation or an S corporation. In other words, cannot be a C corp or an S corp. You and your spouse must be the only people in the business. You must file a joint married tax return, and you must both materially participate in the business during the year. This means that you both are actively working in the business. And the last but not the least, both spouses must agree not to be treated as a partnership, and both must file a Schedule C. One spouse cannot file a Schedule C if the other files a partnership tax return. All right, very important. It is not necessary to file anything with the IRS to make a QJV election. There is no form to actually formalize the election. No, you can just file two Schedule C's, two Schedule SCs, and the IRS will understand that. All right, you just need to add those schedules to your other income on your joint married tax return if you meet all the eligibility criteria. Let me elaborate a little here, folks. Now, if you and your spouse are the sole partners in a partnership, you may be considered a qualified joint venture if you are filing a personal tax return on Form 1040 for that year. You got to file Form 1040 for that year. And the material participation. Now, if you hear the term material in accounting, it means substantial. It means significant. So you have to be actively involved in the day-to-day operations of the business. And the IRS allows the qualified joint venture option only for unincorporated businesses. In other words, you can be a C corp or an S corp. The IRS specifically excludes state law entities, that is LLCs or LPs. LLP standing for limited liability partnerships. Okay, let me give you an example before I close here. Each spouse has a 50% membership in a partnership which has income of $100,000, expenses of $70,000, and a profit of $30,000. So a Schedule C is prepared for each spouse, showing $50,000 in income, $35,000 in expenses, and $15,000 in profits. The total profits of $30,000 is shown on line 12 of Form 1040, with the two Schedule C forms as supporting documents. All right. So preparing Schedule C instead of a partnership return can save you time and money, as I said before. But please, folks, be certain that you qualify for this election. So you want to check with your tax advisor before you file. I'll be right back right after this. Don't go anywhere. Welcome back, folks, to another edition of the Awesome Sweetie Kiwi Show. We're still having a conversation about the IRS Schedule C rules for a qualified joint venture. Let me talk to you about how a husband and wife make the election to be treated as a QJV. Now, I said it a little earlier, but I want to really elaborate here so folks can really understand what I mean. Spouses make the election by filing a jointly filed Form 1040 as well as filing their own separately prepared Schedule C or Schedule F if they are in the farming business. Schedule F stands for profit or loss from farming, or Form 4835, farm rental income and expenses, right? So it could be either Schedule C, Schedule F, or Form 4835 and Schedule SC. Regardless of the scenario, you got to file Schedule SC. This is for the self-employment tax. The ALCs cannot qualify, as I said before. What about the rental real estate income? Except as provided in Section 469C7 of the Internal Revenue Code, rental real estate income or loss generally is passive under Section 469, even if the material participation rules are satisfied, and filing it as a qualified joint venture will not alter the character of passive income or loss. This is very important because there are some tax implications whether the IRS qualifies your income, has categorized your income as active or passive. And in terms of employer identification number, in a QJV, in general, spouses do not need an employer identification number for the qualified joint venture. So spouses electing qualified joint venture status are treated as sole proprietors for federal tax purposes. Remember, the QJV is a federal tax formation. It has no authority, has no validity, if you will, at the state level or county level. All right, so this is very important. So if the spouses are treated as sole proprietors for federal tax purposes, the rules for sole proprietors applies, right? And that means what? It means that an EIN is not required unless the sole proprietorship is required to file excise, employment, alcohol, tobacco, or firearms returns. And if an EIN is required, the filing spouse should complete a Form SS4 and request an EIN as a sole proprietor. And the cool thing here is you can apply for an EIN online. I want to quickly talk about QJVs in community property taxes. Now, the IRS specifically excludes state entities or LLCs from electing to file business taxes as qualified joint ventures, right? I've said that before. But the cool thing here is that, according to our research, there is a loophole in this restriction. LLCs in community property taxes can actually elect the QJV status. So community property is a type of joint ownership of assets. So 9 states provide for this type of ownership between spouses, and business earnings can be included as being jointly owned in these states if the earnings meet other criteria. And this is kind of principle of joint ownership that allows the IRS to treat joint ownership of an LLC by 2 spouses the same as it would for a partnership owned by 2 spouses. So the community property states that I was referring to are Arizona, California, Idaho, Louisiana, Nevada, New Mexico, Texas, Washington states, and Wisconsin. And a disregarded entity is a single owner LLC that files its business income tax return as a sole proprietorship on a Schedule C. An LLC can only be treated as a QJV in community property taxes, so only an LLC owned by 2 spouses can be treated as 2 disregarded entities in the states. So you don't have to do anything to be a disregarded entity. It's just a tax term and status for IRS purposes as a federal tax formation. And what if you file but you're not eligible? You'll have to file an amended tax return if you incorrectly filed as a qualified joint venture when you were not, in fact, eligible to do so. And your new tax form would have to be a partnership tax return. So you can actually talk to a tax professional, an EA or a CPA, to kind of help you handle that situation. So this is pretty much it. One thing I want to say here is that And this is the takeaways of today's show, folks. So spouses who operate partnerships together can actually elect to file as qualified joint ventures rather than file the more complex and expensive partnership tax return. And this special tax treatment was introduced under the terms of the Small Business and Work Opportunity Tax Act of 2007. And you got to be married. So spouses must file joint married returns to be eligible to file their tax returns as QJVs. All right, folks, thank you so much for your attention today. I really appreciate it. Let me quickly recap what I spoke about. I defined what a QJV is, how a QJV works, advantages of a QJV, the requirements for a QJV, how a husband and wife make the election to be treated as a QJV, QJVs in community property states, what if you file but where you are not eligible, and I'll give you a nice recap of the whole conversation. Thank you so much. I will see you next time. But until then, remember, stay marvelous.